I wanted to talk about effectively using the Sharpe ratio part 1. Okay, so a little bit of background. The Sharpe ratio is one of the most common metrics in investing, and it's pretty straightforward to calculate and intuitive. That's one of the reasons why it's so common. But to use the Sharpe ratio effectively, it's important to know the critical nuances of the metric. This segment is primarily going to introduce the Sharpe ratio and discuss how it's used. And then in future segments, we're going to talk a little bit more about those actual nuances and what you kind of have to pay attention to when you actually try to trade based on this. Make sense?
Yes.
Okay, awesome. So just to recap, the Sharpe ratio is one of the most popular measures for stock portfolio risk-adjusted returns, or excess returns relative to some metric. It's calculated from recent historical data to give an estimate for expected performance. And generally, the higher the Sharpe ratio, the higher the expected risk-adjusted return. So this is saying like, okay, great, you got a certain amount of returns, but if you're taking on an exceptional amount of risk to get those returns, that will be reflected in the Sharpe ratio. And we'll look at a couple examples of stocks that returned very similar amounts, but had very different Sharpe ratios, and you will see visually why. Make sense?
Makes sense.
Cool. Okay, so a little bit more about the Sharpe ratio and how it's actually calculated. So to calculate the excess returns divided by the risk, the way that we're going to estimate that is by taking the annual expected return of an asset. So based on the historical returns of an asset on an annual basis, we're going to subtract that from the risk-free rate, which is taken from the 10-year Treasury notes. You can estimate it, roughly from that. And then you divide it by the annualized returns standard deviation. So here, we're basically taking those excess returns and we're dividing it by the spread of that returns distribution, which we're really roughly using to approximate risk. So let's look at an example. So here I have data from SPY, their daily returns from 2015 to 2020. We're looking at that 5-year period of data. These are daily returns. Okay? Yes?
Yeah.
So when you're working with stock data in Excel, Python, whatever it is, it might look something like this. Okay? So on average, SPY returned 0.03% daily during this period. So we haven't talked about this, but for people who might have a little bit of a quantitative background, what is SPY's annualized expected return in that case? So you take 0.3% and you multiply it by 252 trading days, and that's where we get our 9.9% annual returns. So on average, daily, SPY returned 0.03%, and annually 9.9%. So almost 10% multiplying it by those 252 trading days. Okay, very, very good. So now that we know SPY returned an average of 0.03% daily or 9.9% annually, now if we assume that the risk-free rate during this period is 3%, what was SPY's excess returns?
So 6.9?
Exactly, so 6.9%. So these are the excess returns. So if we assume that like every asset should earn at least the risk-free rate, then this is what is on top of that. So when we want to look at like how well this is performing relative to just the economy, that's what we would do to sort of estimate that. So now, if we assume that, this is another background question, so again, no worries if you don't know this, but if we assume that SPY's daily return standard deviation, so looking at the standard deviation of these daily returns, was 0.84%, what is SPY's annualized standard deviation? So how do we now annualize standard deviation? But if you want to take your daily return standard deviation and annualize it, we would multiply that by the square root of 252.
Oh, good.
So we're going to annualize it in a very similar way, but because standard deviation is the square root of variance, you need to multiply by the square root of 252 to properly annualize it. Make sense?
Yeah.
So that's how we calculate our excess returns. This is how we annualize our standard deviation, right? So now when it comes to calculating the Sharpe ratio, so if from 2015 to 2020, SPY's annualized excess returns was 6.9% and the annualized standard deviation of returns was 13.5%, what is the Sharpe ratio? If we have the data, if we have the daily returns, all we need to do is remember to standardize everything, so annualize everything, right? We need to look at the risk-free rate. We need to subtract, right, our annualized excess, returns, or our annualized returns from the risk-free rate to get our excess returns. And then all we have to do is divide it. And that gives us a Sharpe ratio. So that's how we get risk-adjusted returns. So this says how well did you perform relative to the amount of risk that you were taking? right? So we're not just looking at performance overall. We have to look at that adjusted relative to the risk. So if something has a lot of volatility but grows a lot, it might have a worse Sharpe ratio than something that didn't even grow as much but had much less volatility. So, and again, when we're talking about diversification, when we want to look at volatility from a long-term perspective, this can be a very useful metric to be able to do that. Does that make sense?
Yes.
Yes. So very good job out of you guys, Nick especially. Nice stuff. Very good.
Nice.
But when we actually apply it, the Sharpe ratio, it's a very effective comparative metric between strategies, portfolios, or even entire funds. Because we want to, again, look at like, okay, you got this certain amount of returns, but if you took on excessive risk, this might not be a good underlying or strategy for me in the long term. So especially from like a long-term investing perspective, this is a very commonly used metric specifically to compare different types of strategies or portfolio allocations or whatever it is. So again, this can help traders assess whether the performance of an investment was the result of a good strategy or potentially because of excess risk. Make sense?
Yep.
Amazing. So when we want to look at an example, I dug through the S&P 500 and I found this example. So we have Costco and then Carnival Cruise. Both of them grew about 45% in the last year, but the Sharpe ratio of Costco is like double the Sharpe ratio of Carnival Cruise Line because Carnival Cruise had an insane level of volatility. So they both grew by the same amount, but if I'm like an investor and I'm looking at like, okay, long-term, what might be a better underlying for me? Then I might look at Costco instead because it grew the same amount, but it did so with much less volatility, much less variability. And if I'm looking for diversification, if I'm looking for consistent growth, if I want to, this is a historical metric, but if I want to get an example, like if I want to look at an example of maybe what I would pick, this might exemplify that. Does that make sense?
Yes.
Something that actually inspired this segment was that I looked at the Sharpe ratios in the S&P 500. And if you look at a snapshot, it was SMCI, Eli Lilly, NVIDIA were all up there, right? Because even though their moves were so volatile, they grew so much that they had really, really high Sharpe ratios. But now, because they've been a little bit more stagnant, they've actually been dethroned by energy companies. The top 4 components of the S&P 500 from the perspective of Sharpe ratio were all energy companies. General Electric, Energy, CEG, and ETN, they're all energy. So energy is actually dominating the S&P 500 from this risk-adjusted reward perspective, which I found really interesting. The companies that were doing well from a risk-adjusted reward perspective, it was pretty mixed up, right? So Eli Lilly, General Electric, Energy, and then you have NVIDIA, SMCI, PCAR, Core, MLM. It was like good mix, right? Of companies that were doing well from this one particular metric, right? Now it's all energy companies. So like the sector itself seems to be doing really strong, not just from a performance perspective, but from a risk-adjusted performance perspective, which I found very interesting.
Definitely.
Yeah. Okay, we got a couple minutes left. Just going to kind of close up with some slides, but leading into the next segment. So the big drawbacks of the Sharpe ratio, and this is what we're going to really focus on the next couple of segments. But there's a couple things that you have to be wary of when you actually use this in practice. Specifically, overfitting is, I think, the biggest concern when it comes to quant finance. So like, let's say that I'm testing a strategy or a portfolio from 2015 to 2020, right? I'm using that data to sort of develop my strategy. If I overfit my strategy to that specific time period, then I might have a strategy with a really high Sharpe ratio from 2015 to 2020, but 2020 to 2025, it might perform like crap because I fit it to a very specific time and I've sort of like developed a strategy for a market that doesn't exist anymore, right?
Yes.
So this is something that comes up all the time in quantitative finance. This is I think like one of the most important things that you have to keep in mind when you're developing reliable strategies. And so that, if you're not careful, can reduce how well the Sharpe ratio actually works. That's one thing. And then kind of touching on that, historical performance does not guarantee future returns, right? And then I think like the biggest reason why you have to be careful with the Sharpe ratio, especially with options, is that risk is a very multidimensional concept. And standard deviation does not tell you everything about risk. There's a bunch of aspects of risk that standard deviation completely overlooks, like outlier risks or non-normal distributions with skew and kurtosis. And so when you're working with highly complex strategies or portfolios or instruments, right, the Sharpe ratio might be pretty misleading depending on what the actual underlying distribution is. And in my opinion, I think this still has a lot of utility, but in order to use the Sharpe ratio effectively, it's extremely important to understand the fundamental risk structure of the products that you're trading. And then that's number one. And then number two, how do you recognize when the Sharpe ratio might not be reliable? You found this interesting?
That was great, Julia. Definitely learning from you a lot, just like last week, always. I agree with organic farming, Julia. Your genius is on and inspiring.
Thank you, dude. I appreciate that.